India clocked a GDP growth of 6.7% for the quarter ended June this year, and that was the slowest expansion in 5 quarters. In its most recent economic survey, the government mildly lowered its growth estimate for this financial year. The reasons it said were there were too many geopolitical tensions floating around and it always pays to be conservative and so on. A recent report also talked about Reliance Industries actually lowering its headcount for the fiscal ended March 2024 compared to the previous year. The IT industry is yet to go back to its days of robust hiring. How exactly is the Indian economy doing? Let's take a look. Hello and welcome back to Business Matters at the Hindu with me, K. Bharat Kumar. In its most recent economic survey released in July, the government lowered India's growth estimate for this financial year to about 6.57%. This is lower than the earlier estimated 7%, which was done in February in an economic review just before the interim budget. Explaining this, Chief Economic Advisor to the government, Dr. Anantha Nageswaran, said, since January, where we were more confident about a 7% growth, the global economy has become even more polarized. Financial market valuations are now elevated. Given that, we still feel 7% is doable, but yet we want to be not necessarily cautious but somewhat prudent in projecting. We would rather be pleasantly surprised than be disappointed. That is why we are projecting 6.5 to 7%. For a few years now, the Indian government has been spending significantly on public capital expenditure, hoping that that would spur private capex too. How has private capex behaved this year? In an exceptionally slow start to this year, private investment plans announced in this country slumped to a 20-year low for the April to June quarter, with only Rs 44,300 crore being announced as fresh outlays by the corporates. Based on a report by Project Syndicate, a report in the Hindu showed us that the first quarter of the previous year had recorded new investment announcements of nearly 7.9 lakh crore rupees, while outlays worth Rs 12.35 lakh crore were announced in the January to March 2024 quarter. In all, last year had seen investment announcements worth Rs 27.1 lakh crore, the second highest in 10 years. Notably, public capex too has slumped in the April to June quarter, and this, the authorities say, can be attributed to the election season when all decision-making by authorities had come down. Data released by the government on August 30th, along with GDP figures for the April to June quarter, showed that public capex by all governments, central and state, slumped 33% for this quarter compared with a year earlier. In its meeting in early August, the Reserve Bank's Monetary Policy Committee lowered the growth estimate for the April to June quarter to 7.1% from 7.3% that it had projected in early June. The RBI attributed its action due to updated information on certain high-frequency indicators which show lower than anticipated corporate profitability, general government expenditure, and core industries output. And because the GDP print came in lower than the RBI's own estimate, and given that the US Federal Reserve is poised to cut benchmark interest rates in that country shortly, we could expect the Reserve Bank of India too to follow suit and cut benchmark interest rates here with an intent to spur economic growth. How have specific segments within those GDP numbers looked? The gross value added, or the GVA, in manufacturing rose 7%, but worryingly, growth in financial, real estate and professional services eased to 7.1% from 12.6%. Private consumption expenditure rose to a 6-quarter high of 7.4%, and that seems encouraging till you read the RBI's survey, its bi-monthly survey on consumer confidence. Consumer confidence, as per this report from the RBI, showed a declining trend for the second consecutive survey round after showing a rising trajectory in the post-COVID years. Consumer sentiments on major parameters except spending moderated, and as a result, the current situation index declined to 93.9 in July from 97.1 2 months earlier. Lower optimism on the general economic situation, employment and prices led to a 4.1-point decline in the future expectations index, which fell to 120.7 in July. Companies selling fast-moving consumer goods like soaps and shampoos have not seen great volume growth in recent times, though analysts are hoping that a good monsoon would help drive rural growth. A look at the auto industry in India is not giving us any encouraging signs either. Worryingly, Maruti Suzuki, which holds about 50% market share in the country, said that domestic wholesales dipped 8.35% in August compared to the same month in the last year. Compact vehicles from Maruti such as Wagoner, Swift, Baleno and Dzire declined 20%, while sales in the mini segment for the company such as Alto and Espresso also slid by about 13%. To answer the question raised in the title of this video, there is certainly some data that should cause us concern regarding our economy, but there isn't a sure pattern yet. But if we do find a definitive trend, we'll come back to you and keep you updated. And before we wind down, here is this week's quiz question. What is India's share of global GDP now, and what was it in 1947? And here is a nugget of information for this week. Did you know that China's share of global GDP is about 17% as of 2023? That should give you some range in which to place your answer for this week's quiz question. Here is the answer to last week's quiz question. When and where did electronic commerce first take place, and what was the first item delivered? The first recorded instance of e-commerce was in 1971 when students at Stanford University used the US government's ARPANET, which is a precursor to the internet, to buy and sell marijuana. This early experiment was short-lived, however, as the university soon shut down the operation. It wasn't until 1979 that the first commercial transaction was made online. This involved the sale of a Sting album from a company called Netmarket. That's all we have for you this week. Until we meet again, have a lovely time ahead. But before you go away, do not forget to like, share, and subscribe if you like this episode.